Hi, I'm Bob. In the previous video, we have drawn the long-run competitive market supply curve for the ice cream cones. We assume that the ice cream firms are identical and the market entry and exit are free. The long-run competitive market supply curve is a horizontal line at the market price, which is also the firm's minimum of their average total cost. However, if the perfect competition assumption does not hold, the long-run market supply curve might slope upwards. Take our ice cream firm as an example. First, we consider a situation in which the average cost increases as more and more ice cream cones are produced. It could be due to the limited quantity of ice cream machines available. As the ice cream firms purchase more and more ice cream machines, the price of the machines increases, and therefore the production cost increases. So, even if the entry into the ice cream market is free, the increased average total cost leads to a rise in the market price. The long-run market supply curve is upward sloping as a result. The second case, where the market supply is not horizontal, is because the firms differ in their production cost. Some firms have lower average cost than others. They can start producing at a lower market price, but they could not produce as much output as the market demands because each of these low-cost firms has a limited capacity, and the number of them is also limited. The high-cost firms join the market and start to produce at a higher market price. So the long-run market supply curve slopes upwards. The third reason for an upward sloping market supply is that the entry into the market is restricted. Suppose the government restricts the number of firms in the local ice cream market, and no firms can freely enter the market. The only way to increase the market supply of ice cream cones is for the existing firms to produce more, because individual firms' supply curves slope upwards. The long-run market supply curve is also upward sloping. In a word, the long-run market supply curve is a horizontal line at the minimum of the firm's long-run average total cost. If input prices are constant, firms have identical costs, and firms can freely enter and exit the market. But if any of the above factors changes, the long-run market supply curve could slope upwards. Another concern is the zero economic profit in the long run. Firms are making zero economic profit because the total revenue is equal to the total cost. Why do competitive firms stay in business if they make zero profit? Remember, the profit is equal to total revenue minus total cost, and total cost includes all the opportunity costs. In our ice cream firm case, the total cost includes all the time and money the firm's owner devotes to the business. In the zero profit equilibrium, the total revenue equals the total cost. That is to say, the total revenue compensates the owner for the opportunity costs. Suppose the ice cream firm owner has invested $100,000 in the ice cream machines, which otherwise she could have deposited in a bank and earned $3,000 a year in interest. In addition, she had to give up a job that would have paid her $30,000 a year. Then the ice cream firm's owner's opportunity cost of running the ice cream firm includes both the interest she could have earned and the foregone wages, a total of $33,000 a year. Even if the firm's profit is driven to zero, the revenue from selling ice cream cones compensates her for these opportunity costs. Keep in mind that accountants and economists measure cost differently. Accountants keep track of explicit costs but not implicit costs. They do not include opportunity costs of production. As a result, in the zero profit equilibrium, economic profit is zero, but accounting profit is positive. Our ice cream firm's accountant, for instance, would include that the firm is making a positive accounting profit of $33,000, which is enough to keep the firm in business. Thank you for watching this video and subscribing to my YouTube channel. See you next time.